So I'm going to kick it off. I have a bit of an intro to describe what we're doing, and it'll give other folks a chance to come in to the call. My name is John Jeffries. I'm the CMO at Blocknative. I have been working full time in blockchain since 2017, tracking digital currencies since far before that with DigiCash and eCash. I originally went down the rabbit hole after reading Nick Szabo's white papers on smart contracts and was totally pilled at that point, and even worked with Nick uh, at a company called IronKey. Uh, Prior to Blocknative, I was a CMO at CipherTrace, which is now part of Blocknative or part of MasterCard. But I joined Blocknative a year and a half ago because I was intrigued and fascinated by the opportunities of the pre-chain layer. But Blocknative is a leader in leading Ethereum block builder. The company's real-time infrastructure lets validators and searchers demand staking rewards and trading profit, and our transaction orchestration platform provides complete transaction control. Founded in 2018, Blocknative helps inform and power forward-thinking projects such as Lido, MetaMask, Curve, Balancer, the Ethereum Foundation, Polygon, and others. Now, I have been excited about this conversation all week long because today we have with us Pat White. Pat is the co-founder of Bitwave, an enterprise platform that customizes accounting and bookkeeping for tax tracking for on-chain transactions. And from my perspective, that the tax issues have been what kept me away from being an active participant and active trader for years and years. And with companies like Bitwave, now we can trade and make sure that we stay legal with respect to the U.S. government and other governments and our tax obligations. Pat is a recognized software engineer leader with over 10 years of experience building enterprise software at top tier teams, including Intuit and Microsoft. Um, Prior to Bitwave, Pat started a consulting firm which developed enterprise search engine, which was acquired by Cisco in 2016. Bitwave
JJ.
is the
Oh,
yay.
sorry. Yeah, that's great. What a great intro, man. Thank you. I appreciate it.
Sure,
Yeah.
sure. Save
Do
that
it. I
last
cut you off
part.
before you intro. I cut you off before you intro Bitwave.
Go
Go
on.
ahead, intro
You know what?
Bitwave.
Why don't you intro Bitwave then?
All right.
What does
Bitwave is the number one digital asset tax and accounting solution for businesses that use crypto. So the way that we sort of think about the retail users out there who are um, really just looking to do their taxes. So folks like yourself, you just sort of mentioned all you want to do is, hey, I bought some Bitcoin, bought some Ethereum, and really I'm just going to be reporting my taxes at the end of the year. That's kind of a whole different ballgame. What we do is we focus on businesses who care about taxes, obviously, but really their day to day operations. I always kind of like to joke about um, the difference between taxes and accounting is it's subtle, but like taxes tell you how big I'm reporting my taxes at the end of the year. That's kind of a whole different ballgame. What we do is we focus on businesses who care about taxes, obviously, but really their day to day operations. I always kind of like to joke about um, the difference between taxes and accounting is it's subtle, but like taxes tell you how big a check to write to the IRS. Accounting tells you how much money you've been making. So people tend to like accounting a lot more than like the tax disciplines and things like that because it is more about like, hey, how much money have we been making on our staking and MEV and all that sort of stuff. So Bitwave focuses on how do you enable digital assets for enterprises? How do you focus on the accounting and tax implications of that? And in a lot of cases, like what we're going to be talking about here today, it is a lot about like, hey, I as a individual making money here, like I need to make sure that we are correctly, or as a business making money here on validators, I need to make sure that we are correctly accounting for that revenue, accounting for all the activity we're doing, and then being ready to pay taxes on the other side of it. So that's Bitwave in a not nutshell.
Great, great. That was an excellent overview. So, who has to pay taxes? When do they have to pay taxes? And what are their obligations?
If you are a U.S. citizen, you have to pay taxes. If you are a U.S. Domiciled business, you have to pay taxes. If you are a business that does business in the U.S., you most likely have to pay taxes. All that could be a little bit that in the U.S. that can be a little bit dicier, and you will often have to pay some form of taxes in the country of your origin, unless you are based out of the Caymans or somewhere like that. But the joke that I always say is, it's we every now and again it happens less and less. Like I've been doing this since 2018. And when we started doing this in 2018, we'd go to these conferences. Me and my co-founder, we go to this conference, and someone would walk up to our booth. They're like, "Hey, what do you do?" Like, "Oh, we do, crypto accounting and taxes." And they look deadpan at me, like, like I will never pay tax on crypto. Like I will never do that. Like I do not do it. And screw the government. I will never pay taxes on crypto. And it's like, all right, man, like that's a perfectly reasonable stance to take. If your freedom is not an important thing to you, and if you don't really care about things like money, but we don't hear that as much anymore. So at this point, like if you're in crypto, you want to figure out a way to get your taxes done correctly. There's a lot of great solutions if you're an individual. We partner with like we work with all of you guys. We really like CoinTracker. They're a really good group of dudes and ladies, women and men. But it's if you are a business, you want to get serious about digital assets. You want to get serious about digital asset accounting, which is that you need to know exactly how many tokens you're bringing on your inventory, what you're doing with those tokens, what your gain loss is. All that needs to get on your books because your investors are going to ask about it. Your investors are going to be genuinely curious what your how much money you're making as part of any different activity you have with crypto, how much money you're making holding crypto or selling crypto, whatever it is, and got all these things kind of going on. But short answer, probably everyone has to pay taxes, and don't. It's not the best idea to just say, hey, we're not going to pay taxes.
So if I've declared mine, but if one has not yet, declared their crypto earnings, and this is they're finally come to the point where they feel that that it's an obligation they must meet. What's that first year look like and feel like to them? And are there any specific decisions they need to make about how they account for it, FIFO versus LIFO, or other sorts of issues?
Yeah, so it's if you are if you pay your taxes and you are looking to kind of come right, um, there's a lot of different options for how you want to handle that. But first and foremost, I mean, all this stuff kind of comes into play is get in touch with some sort of tax professional. I mean, honestly, like just get in touch with a CPA, a tax professional, whatever it is. There's one of these really funny things I like to personally think about, which is, it's true to the benefit of the guy who came up to my booth and said he would never pay taxes. Many people in crypto are both nervous about taxes, don't really like the notion of taxes, and honestly, like maybe have some like libertarian proclivities that lead them towards not reporting. Get in touch with some sort of tax professional. I mean, honestly, like just get in touch with a CPA, a tax professional, whatever it is. There's one of these really funny things I like to personally think about, which is, it's true to the benefit of the guy who came up to my booth and said he would never pay taxes. Many people in crypto are both nervous about taxes, don't really like the notion of taxes, and honestly, like maybe have some like libertarian proclivities that lead them towards not reporting income, not paying taxes, things like that. It's an interesting way to think about it, but like it's not always necessarily the best idea because like at some point you are going to have to declare your income you're getting from taxes, all the stuff you're doing. You are going to have to declare this stuff. So you actually there's a natural proclivity to like say, hey, I'm going to put off declaring revenue. I'm going to put off declaring this staking rewards that I'm getting, whatever it is. It's an interesting way to think about the world, right? Like, I mean, you naturally do want to say like, hey, I don't want to talk about, I don't want to recognize the income right now because that's going to hit me today. But the way that crypto taxes work is that the day that you recognize the income. So we're going to spend a lot of time talking about staking and validating income today for especially around like ETH2, obviously. I guess it's just Ethereum now. I keep calling it ETH2. I don't really know why I do that, but in particular, you are, as you are getting the ETH deposited into your account. So this would be either, I mean, today it's obviously your unwithdrawn account, but if you're using something like one of the liquid protocols that let you do have some amount of liquidity there, as you are getting tokens deposited from validating actions, so these would be block rewards or MEV, you are getting revenue in that token. Like this is it would be the same, like a really good example of this, because it can be a little hard to maybe wrap your head around this, but like, let's imagine a world where we didn't use money every single day, but we still have the IRS. I know that's kind of a funny world to imagine, but if I have a butcher shop and I have a piece of meat and someone comes in and they trade painting my house for a piece of meat, it seems like a bad trade, but you know what? I'm not going to argue. That is revenue. Like you do have to recognize that type of transaction as revenue. Same thing goes for if they give you something more tangible. So they give you a carved wooden sculpture, that's revenue. And then of course that then extends to Ethereum. So someone gives you ETH, you give them meat, that is revenue that you have to recognize. The way these laws all work is that the moment, so you basically, when you get the ETH, you are striking a price that is both the income that you are recognizing. So someone pays me today, ETH at 1777, whatever it is. I'm gonna say, okay, someone gives me one ETH today for work. I got one ETH of revenue, which is worth $1,700. That $1,700 is both my income, but then also it is my cost basis going forward. So the nice part about that is that now I've struck a lower. There are reasons to not necessarily want to put off recognizing income because a lot of us believe that next year Ethereum is going to go up. So if Ethereum goes up to $2,000, $4,000 next year, and I had the chance to recognize both income at $1,700 today, as well as I have the opportunity to basically set my cost basis for ETH at $1,700. That's great. Like that is good because what you want is you as a kind of holder of securities. Now it's really hard to time the market, but you really do want to minimize the amount of income you're recognizing, and as much as possible, take that sort of normal income and turn it into gains, which is what you are actually getting when you go and sell the ether. You are paying capital gains tax on the delta between that $1,700 and whatever you sell it at. And capital gains tax in America is much more favorable than income tax for tax purposes. So the advice. So I know this is a very long-winded question, but at a high level, like don't put this stuff off because you think that will be tax advantageous. It might be. Don't get me wrong, but don't just assume out of the blue that this is going to be tax advantageous. There are very real reasons why you actually do want to be more aggressive about getting all of your stuff in order. If you owe back taxes, if you've never done this before, talk to a professional, especially someone that knows crypto. You can reach out to us. We have an enormous network of CPAs, accountants, tax folks that all know crypto extremely well. We can then, they can then help you both do all the recognition. And honestly, right now is not a bad time to do it. Like it's not the worst time because the market is down. We're sort of in a bear market. It is not a bad time to actually go and do any recognition you need, potentially pay any fines that you need, and then get ready for the bit coming up next, hopefully with lower cost basis ETH.
And so is it worth harvesting losses at this point, with the markets being down, assuming that some people are upside down?
Yeah, so tax loss harvesting is a really interesting thing to talk about here. What I like to say here is, so first and foremost, be a little bit careful with this because even in the best of times, tax loss harvesting has a iffy relationship with the government. I mean, look at the way to analyze any single problem in the tax world is to basically say, well, what would the IRS do in a perfect world, and then search for any situations where there's possibly a loophole or something that's been created after that. But like, always assume that the IRS is out to get the max amount of money. Tax loss harvesting is a really interesting mechanism. I think most people got familiar with it early on because we've had what are called wash trading rules in America for a long time now. So what wash trading is that if I go, it's actually a really severe. The way they wrote the rule is actually very, very severe. So the way the wash trade works is like, let's say I own Microsoft. Microsoft goes down $1. I sell it and buy it right back. And theoretically, back in the day, I mean, that is what tax loss harvesting is, right? Like that's what the way when you do tax loss harvesting on crypto, like Bitcoin drops below your sell price, your buy price, you sell it, you buy it back right away. And theoretically, you're then taking that loss and resetting your capital gain to your cost basis to lower. This was being done in the public markets. A law was passed that made this not acceptable from an accounting perspective or from a tax perspective. So that the way it works today is that if you sell and then rebuy the same security like Microsoft stock within a month, you actually end up getting penalized where your whole cost basis resets to the higher of the two cost basis essentially. Or the lower of the two cost bases. I have to remember exactly how they do it. But they basically they wrote the law to heavily disincentivize this, and you are not allowed to take the capital loss on that transaction. So it does do a reset of it like resets your cost basis, but you don't actually get any benefit from it. Really, really strange how they like. I mean, like obviously, I said strange how they wrote it. It's not at all strange. Like if you analyze every single thing around tax, which is like how do you maximize money to the government, because that's how they're optimizing this stuff, then obviously that didn't make sense. So in crypto, depending on how you read a particular law, there is a way to make an argument that we do not that wash trading rules do not apply to crypto. And so all the tax loss harvesting stuff that you've seen out there generally does depend on that particular rule. So now again, it's a particular reading, a different reading of the rule. Especially one that sort of relies on a lot of what we've learned recently about how the government thinks about all this as securities, says that in fact, wash trading rules do apply to crypto and you shouldn't do it. So that's a very long way of saying that if you are looking at tax loss harvesting from the perspective of I have Bitcoin. I'm going to sell it and buy it back immediately to take a loss and reset my cost basis. There's a very good chance that that's not okay today. And even if it is okay today, there's a very good chance the IRS will do a retroactive rule around it. So there's other things. So like, in the normal world, we also are very careful about laws. It's very hard to pass a law that's retroactive. It is, if painting your house, if someone decides that they want to make painting your house blue a crime, it's very hard to pass a law that makes it illegal to have painted your house blue already. If for no other reason than political reasons. It's also hard from a jurisprudence issue. The IRS does not suffer the same the same issue. So the IRS, like if they decided that wash trading was always wrong for crypto, like they make a declaration, and suddenly you have to go back and restate 5 years of taxes where you were wash trading, where you were basically doing tax loss harvesting. So again, this is a place to go talk to a tax professional here. But one of the things that you can do is so the way that people do tax loss harvesting in automated brokers like Betterment and things like that is they tend to go between equivalent securities. So what that is to say is that you might, like, let's say I have money in Betterment and I turn on tax loss harvesting. They put the majority of my money in a Vanguard Admiral mutual fund. And when I turn on tax loss harvesting, assuming the market's gone down, what they're going to do is they're going to sell the Vanguard mutual fund and they're going to buy a Fidelity mutual fund that essentially has very, very similar exposure to the market. So it's a Fortune 500 weighted average weighted fund. They're gonna sell one and buy the other. And the idea is that they are essentially equivalent instruments, even though they are completely segregated actual securities from a legal perspective. So there are potentially ways, again, talk to your tax advisors about this, but there are potentially ways to get to do tax loss harvesting in a more what would be friendly, even if wash trading rules kind of change. One example is going from BTC to wrap BTC. So again, depending on your tax advisor, you might be in a situation where wrap BTC is treated as a separate security from BTC. So if that's the case, then basically selling your BTC and buying wrap BTC is a form of tax loss harvesting. It's kind of getting equivalent to that Admiral fund thing without in straight wash trading. Now, even that is kind of iffy because a lot of people treat wrap BTC, in fact, as equivalent to BTC. So what that means when you do that treatment, you get this really great benefit that trading into wrap BTC does not create a disposal of your BTC. So if I have BTC at $5 and I wrap it, I don't want to suddenly pick up a capital gain of whatever $28,000. I wanted to say, hey, no, it's the exact same instrument underneath it. So in that case, you basically are treating the instruments as equivalent. So then you can't do these wash trade rules don't apply to that. So then you might look at something else like going into a liquidity pool. So like let's say you go into a liquidity pool with BTC and USDC or BTC and ETH. That's a way to basically trade away, dispose of your USD, your BTC, acquire a Uniswap liquidity pool token, something like that. There's other options floating around here, but one of those things that like these, hopefully this just sort of shows the complexity with which this is, and kind of like it shows the danger in some ways of kind of doing this wrong because you want to be very thoughtful about this. Like just because someone posts an article about tax loss harvesting does not mean that like A, it's okay, B, that it'll be okay forever, and C, that you should do it. You should absolutely talk to someone who can kind of give you a little bit of guidance around there. Whew, long answers.
Great, thanks. Yeah, that maps really well to the advice that I received. But as much as I'm a fan of CoinTracker and it's really helped me manage my annual sort of gathering of data, they torture me on a weekly basis with my harvestable loss. And I just, A, I don't want to do it, and B, I don't need the weekly reminder of how much I lost.
Yeah, it's been a tough year for us all. It's been a tough year.
Well, the advice I got from my advisor is that, if you like your position, and I believe my positions are coming back, then just sit tight and ride it out. But that said, I've heard that there's various different issues for corporations holding non-stable volatile tokens like Bitcoin and Ethereum in their treasury, but I don't understand it at all.
So let's talk about what it means for businesses to hold crypto. So again, this gets a little bit back to this idea of accounting versus tax, because most people are not doing, like, if you are just sort of if you are validating and if you're like on ETH2 using Blocknative to build blocks, you're getting some revenue off of that. You're not really falling under what would be called GAAP, generally accepted accounting principles, as an individual. Like, you should still be, you should still be recognizing the ordinary income for taxable purposes, but you don't really care about accounting for it correctly. The second you're a business, you actually do need to account for it correctly. So, when you are a business, you pick up a responsibility to tell your board, your investors, potentially the government, your information about your position as a company. And so there's a whole host of rules that go along with that. Obviously, thousands and thousands of rules, and this is where CPAs and public accountants make all their money. But so when you take something like digital assets onto your balance sheet, you basically pick up obligations to follow a set of rules on how to treat those. So what happened? There's kind of a super interesting history here. If you're super interesting is a very, very relative term here. But if you are interested in things like the history of accounting, there is a super interesting history here, which is that digital assets, the Bitcoin network, it was talked about kind of launched 2008, picked up steam through 2011. It really had its breakout year. 2014 was the first time that I'd say the accounting industry writ large sort of actually took a serious look at digital assets. And what happens? The big four all kind of got together and sat down and said, "Hey, we need to analyze this for accounting principles." And so they said, well, is this inventory? Is this a thing that I paid someone to build that's now sitting in a warehouse that I'm going to sell, and I physically move it out of the warehouse when I sell it? No, not really. Is this cash? No, at that point, it certainly was not cash. When you only had Bitcoin and Ethereum, there's no world where you would have called those cash equivalents. And so they ran down the whole list of all the different things that you can kind of treat digital asset as. And they ended up on this thing called an intangible long-lived asset. It's not everybody has these on their balance sheets, but it's not a particularly common thing to do a lot of manipulation around. So if you were to buy a domain name, so you buy jj.com, that $12 you spent on a domain name becomes a intangible asset on your balance sheet because it's not an inventory item. You're not selling it. You're just sort of sitting on it. And there's this notion, it's sort of funny. There's other ways that you can get intangible assets, but that's a really easy one to understand. So imagine someone like FTX that it was a 3-letter domain name. So it probably cost them several $1 million to buy the FTX domain name. They're sitting on this domain name. It's on their books as several $1 million, whatever they paid for it. And then one day they do terrible, terrible things, hurt our industry, it's a complete, fraud. And suddenly the FTX name is worth literally nothing. So they go through this process that's called impairment, where they basically take that domain name and they mark it to what they think fair value is. And honestly, fair value for FTX today is not very much. So let's call it $10. That's probably a bit of an exaggeration, but hopefully it gets the idea across. And so you actually have to mark down this intangible asset, and you can never mark it back up until you sell it. So basically, once you've the way that these work is that once you've picked up a damage to the brand or a damage to this intangible asset, you are now SOL. You are at a $10 price until you sell it. That's the accounting treatment you actually apply for crypto ad businesses. It's called impairment. And what happens is, you are basically asked to value the Bitcoin every single day. And if the price goes below what you paid for it, you are expected to take what's called an impairment expense, which is literally like giving money to somebody. So I go to a store and I spend $5 on a banner for a conference, that's an expense. An impairment expense is literally the exact same thing. It's your P&L, your investors see it. If you guys I'm sure have seen this in the news about Tesla taking $100 million impairment expense, all that kind of stuff. That's what this is all tied to. It's sort of a really complicated model. Now, what's happening is it's actually changing. So FASB released some guidance, and they're going to be changing a bit of these treatments. For, in particular, ETH and BTC really stand out as the ones that are going to get changed. Other ones may or may not. So where there's a little bit of confusion right now would be the way they worded it, carved out governance protocols. So if you're looking at a uni token or something like that, where there's an underlying right that's basically being conveyed through ownership of the token, that would be like a uni token. Or I don't know if you guys saw the news yesterday about the house that sold on Solana that had rental property revenue associated with it. Those would all probably still need to get impaired, honestly, even under these new rules. But for Bitcoin and ETH, they're doing what's called fair value, where basically every day you look at the price and then you pick up either an expense or a revenue item for that. So if it goes up, you just got $3 of revenue. If it goes down, you get $3 of expense. And the idea is over time it sort of balances out. It's a more realistic view of the assets on your blockchain. But either way, that is a burdensome, right? So like you as an individual, it would be a real pain in the neck if every day you had to revalue your crypto and report that to the IRS. But in the crypto accounting world, that's what you have to do. Is every day you have to revalue your crypto. That has to hit your P&L. That goes to your investors. And at the end of the year, it offsets, but it does go to the IRS and things like that. There are other complexities I won't get into too much, but there are things that are more fun to talk about. So the technicalities of like GAAP and tax rules and things like that are, they're fun if you nerd out on that kind of stuff. But if you nerd out on crypto in general, there's other stuff to sort of think about that is really interesting. For instance, like you as a business, you have the people that work for a business in a executive leadership role, so CFO, CEO, things like that. They have a fiduciary duty to their shareholders, to the board, and to the business in some ways around digital assets. I mean, around their cash that they're sitting on and all their assets. And so when you bring digital assets onto the balance sheet, you actually are picking up a really interesting fiduciary duty and a what we would often call like a control duty for your organization. So suddenly, bank accounts are pretty well understood, right? Like you have a bank account for your business, you set up a couple of signers, you put an approval amount that, hey, Bob's allowed to only approve to $10, things like that. Crypto, all of that stuff is very nascent. Like there's ways to do all of anything you would want in the crypto world. There's ways to set up, special multi-sig wallets that have approval limits, and there's ways to set up MPC wallets that have multiple signers and things like that. But you have to do it, right? We don't have like a standard game plan that every business can run through. So when digital assets come out of the balance sheet, like if Walmart were to suddenly spin up a project and buy $100 million of Ethereum, they would have to go through a very serious project internally to determine what are the control mechanisms here, who gets access, how do we control access, how do we audit access, how do we do our financial reporting. Like you as a treasurer pick up these responsibilities that just didn't exist. Like you pick up weird counterparty risks. At the moment that you are holding ETH, like, well, if you have employees holding it, suddenly you have a counterparty risk with your employees. If you're keeping it in an exchange, you have a counterparty risk with that exchange. If you keep it with a custodian, you have a counterparty risk to the custodian. You have a counterparty risk to the network. So, like, I think we all believe deeply in Ethereum, but like take another network that's not as big or well known. Like Solana is probably maybe a good example here because you pick up you are saying, hey, I'm holding this asset. I can sell it whenever I want. I can move it whenever I want. But Solana goes down every couple of weeks. Solana goes down for 8 hours. So that's actually not true, right? Like from a pure controls and and internal controls perspective, you don't have free movement of this asset at all times, 24 hours a day, 7 days a week. You have this counterparty risk with Solana. So what happens if when Solana is crashing, like the price is crashing, then the network also goes down, so you can't sell it. So you pick up these other things that are really fun to think about. Well, fun is maybe a relative term here, but like that are more interesting to think about. Like how do we control the crypto in our company? How do we think about private key management? How do we think about risk? How do we think about risk towards as counterparty risk and as exchange risk and network level risk, protocol risk going into? I mean, Euler just had that huge hack, and we had a few customers like deeply impacted by that. So you have protocol level risk with DeFi protocol. So there's a lot when you are a business starting to take crypto. There's a lot to think about. It's a lot of fun. Like, don't get me wrong in any part here, but there's a lot of stuff to think about. And you just have to kind of think very holistically about the digital assets on your balance sheet.
Yeah, the finance geek in me and the cybersecurity geek in me,
Yeah.
like going down that path.
Yeah.
Just switching gears a little bit because I know we have a lot of validators that are really interested in tax issues, and and like me, they probably are. Some potential validators have stayed out because of the uncertainty around that. And I would say in the last years, a lot has
Yep.
changed, particularly on the Ethereum network as we move from proof of work to proof of stake, where individuals and companies are staking ETH. Right now, there's about 31 billion of staked ETH securing the
That's
network.
crazy. It's crazy how much
Is
it
it?
really like. It kind of boggles my mind, to be honest. Like the amount of money, because it's like the cool part about staking is that it was this movement from using chips and energy cycles to using money to secure the network. So this basically means that in order to attack the network, you need $10 billion like lying around. Like there's a handful of people that could do that. Like Elon Musk, I'm sure if he was really bored, I guess he could do a pretty interesting attack against the Ethereum network. But but outside of something like that, it is this incredible self-sustaining tool that we've all built here. I mean, it's so cool.
Super cool, right? And there's also this dynamics around MV, which, as we know, is sort of the premium paid to validators for influencing the order of transactions on a block. And I know we've had some conversations prior to this about how it impacts both accounting and tax. But I think one of the really fascinating things that's right on the horizon is the Chappella fork.
Yep.
Right, it's just 13 days away, and all of a sudden all these folks that have locked up all this ETH, the 17 point almost 18 million ETH has been locked up, and it can now be unlocked. So I'm sure people are exploring whether or not they harvest losses, reallocate assets, restake, either in the same place or move it around. And so I think that creates a whole bunch of interesting opportunities and issues.
Yeah.
Which I'm just going to open up and let you jump in.
100%. So up to this point, ETH, money locked in the Beacon chain, has had it's actually not at all clear. Well, I shouldn't say it's not all clear. Like if you're a business and you have a technical accountant do an analysis of ETH, it ends up looking like a long-term derivative contract where there's some sort of risk-based chance of it being paid out or not being paid out. And so there's actually there are very clear rules for how you handle that in the accounting world. It's a little bit less simple when you get to individuals. So this is a great reason you do actually want to have it's a great reason why you do want to actually have a tax professional around to actually make some analysis here. Because at the end of the day, like when we all put money into I run a couple of validators, like when we all put money into when we staked it, there was absolutely no guarantee at that point that that ETH was ever going to be come out. I think we all believed very deeply that it would. Like, I don't think anyone would put whatever 32 ETH into a contract if we didn't believe that we could get it out at some point. But there was no guarantee. There was no timeline. The code had yet to be written. There was nothing that would actually guarantee that we could get that money out. So, so that demands a special kind of treatment where it's almost like a loan in some ways. Like it's not exactly a loan, but you can kind of think of that way. We basically loaned it to the network. There's a non-zero chance that they would default on the loan. We have to treat it correctly. We're then getting interest on that loan in some ways. So what I'm going to kind of walk through here is like different ways to describe this to your accountant so that they can make a decision about how exactly for tax purposes, either at your business or you as an individual. Of course, what has changed over the last month is that now we actually do have a hard date in the sand where we are going to be able to pull it out. So that intuitively already changes the nature of this kind of contract. I use contract in the typical legal sense here. Like we have a contract with the Ethereum network. Now it's not a written contract, it's not a signed contract, but like you do have this kind of contract with the Ethereum network that is now they've come out and said, hey, 15 days from now you're going to be able to withdraw your money. So what that does is it actually changes it from a kind of a what we've been talking about here, which is like a derivative where it's a indefinite derivative where you're actually not entirely sure when it's going to be released. So now like, hey, I've got a hard date when this is going to get released, and you might have to start recognizing income. You might have already wanted to recognize income. You might not have. There are different ways to have treated ETH up to this point. Many people were recognizing income every single day. They would look at their balance every single day. They would then say, okay, that's how much money I made today as it went up, and they would basically recognize it at that moment in time. Other people have been sitting on and saying like, hey, until I know I can withdraw, I'm not going to recognize any income here. I'm going to treat this as a liability on my balance sheet. I'm not going to recognize any income until we can actually officially withdraw it. Because that's on the horizon, all of that's going to actually all of those chickens are going to come home to roost here. So you actually have to figure out how exactly you're going to treat it. A benefit, so because we are in a situation where people are kind of choosing, like assuming you haven't done your taxes yet, you kind of can do a little bit of choosing how to recognize this. And I'll throw this out here for the folks listening right now. Again, like there is a natural proclivity to say like, hey, defer recognizing income or this, like don't pay the government tax, like all that kind of stuff. At the end of the day, it might be very advantageous. Like if you think about the last year, you've basically been DCAing. If you were to recognize your income every single day on the Beacon chain, you have basically been DCAing dollar cost averaging into Ethereum by buying a little bit of ETH every 13 seconds, every 12 seconds. And honestly, you've been doing that through a bear market where your cost basis has been going down and down and down and down. So there actually is a very material difference if you decide to recognize all of your income next 2 weeks from now at $1,700, $1,800 versus if you decide to recognize what you've been DCAing over the last 18 months. That could be a very material difference between both the income that you got and the cost basis. So this is all a very long way of saying, like, go and talk to a tax professional that can help you with this. This is not tax advice. Like, go and talk to a tax professional that can help you with this. These are the different considerations. It's pretty easy to figure out. Like, if you just take your total holdings, divide it by the number of days you've been staked, divide that by, look at the average price across that. You can get some sort of sense for like your cost basis on average. If you treated more DCA versus more immediate. Make a decision, and then whatever decision you make, you're gonna have to stick with for the rest of your staking life on Ethereum here. In terms of if you want to recognize income every day, or you just want to recognize it when you withdraw it or whatever it is. So there was a lot of words to talk about the different complexities that come up, but hopefully that is interesting because you really can today make two different choices, and you should people, whether you are a business or individual, should talk to a tax professional about how to sort of make that decision.
Yeah, that was another good point you made, Pat, was none of this is financial, legal, or accounting advice. Seek the advice of a professional before you act. This is just a discussion amongst friends.
Exactly.
But that it raises a question, if I'm a staker and I stake my ETH at a much higher price than it is right now, if I restake it or rebase it, is there a tax implication? And what if I restake it, on my own hardware versus restaking it somewhere else or move it around?
Yeah. It gets really complicated, because the question about like own hardware versus moving around tends to get into this really interesting question about securities, because that's where you are. Let's say you take it and you turn it into Lido or one of the other like liquid protocols. Suddenly you have really changed the nature of the security. You've changed the nature of the contract. You've changed the liquidity of it. Like you've changed your ability to get access to liquidity. So all of that, if you were doing any of that kind of stuff, all of that will affect both your accounting and taxes as a business running these nodes. And you definitely need to keep an eye on it for sure. I mean, if you've been using one of the liquid protocols, like you are in a situation where you actually had a more liquid asset, it did not necessarily fall under the same kind of derivative terms that we are thinking of, and you really actually want to do more recognition of gain loss and things like that up front. So, long story short, it's a tough question to answer. Definitely talk to an advisor about it, and honestly, if you have enough money that this matters, it's worth spending a few $100 to talk to someone about it, because you could have very, very large differences in your tax liability from these actions.
And I've heard even amongst the liquid staking providers, the way that the rewards are granted can impact your liability. So with Lido, I believe it's issuance versus Rocket Pool.
Yep.
The underlying token appreciates.
Yeah, they're both pretty similar. Rebasing from an accounting perspective is, it's really, so there's two parts about it. So one is if the token appreciates versus if you actually change your amount of token you're holding. Both of those different liquid protocols use different mechanisms for how they do it. If the amount of token you're holding changes, that is a taxable act. That is a taxable or a accountable action you need to take care of. If it's just the appreciation of the underlying asset, that does also leave a little more flexibility for putting off your income recognition. But again, just keep in mind, you may still need to do income recognition. There's no foolproof fair game here for avoiding the tax man. Tax man.
One of the certainties.
Yeah, one of the certainties.
That's great. Now, I know this Jarrett versus United States case has sort of gotten a lot of attention and a lot of heat around the Tezos staker. Do you feel like going into that at all? Or do you have that case?
Happy to talk about it, but I don't have much interesting to add. I mean, at the end of the day, the way the court ruling was written was incredibly narrow and it is not a general thumbs up to never recognize staking revenue until this was a very, very particular case where the IRS, the way that the decision was sort of ultimately handed down, it wasn't a court decision, it was an IRS action, but was basically like it was I think we could announce it it was if you're having a fight with your significant other and you're like, let's not talk about this right now. Like you go to a dinner party, let's not talk about this right now. It was like that. Like there was no hard decision was made. No one won. It just they put it off. They put it off until a later point in time.
Wait till we get home.
Wait till we get home tonight to argue about this. They just sort of set it aside for a little bit. So I would not base my entire because essentially like the problem is that like the weirder stuff you do from an accounting and tax perspective, the harder it is to unwind it, and you end up paying penalties and things like that. So there's things that you are legitimately, like we sort of talked about this, spec ID, the IRS has come out and said that specific lot identification is okay for crypto. But the problem is that there's a lot of squishiness behind there. Like, does that mean that I have to track exactly what Bitcoin address I have crypto in and then spend it from that address? Like, there's all this sort of like up in the air kind of stuff around that. So, what we see with some of our customers, they actually keep two sets of books where they actually know they'll run spec ID in order to get their tax liability optimized, but they will also run FIFO in the effort to basically understand what the tax liability would be in a worst case scenario. And then oftentimes they'll actually keep a certain amount of money around. And this is either a best practice or sometimes, depending on your jurisdiction, this is a requirement by the local GAAP. So in Germany, you actually have to you actually have to keep this on your books. If there's any amount of ambiguity about a particular rule and you're taking an optimized version of it, you have to keep the full liability on your books forever. That's not how it works in the U.S. Smart companies still stay heads up about what their liability could be. And so they'll keep an amount of money to pay FIFO. And honestly, it's one of those things where like they're not, they were trying to do letter of the law. They were doing their best. You're not going to see massive. Obviously, this is not legal advice, but like the IRS is going to come after you if you followed a guidance they gave you and then a technicality on the other side made you change. That's going to be a more reasonable discussion than if you try to take a really aggressive stance that's not supported by really anything, which is where the Jarrett case comes in. There's no precedent set by that, so you can't use that precedentally. You can't say, "Hey, based on this, I'm not going to pay taxes on my staking." Like that doesn't work. And it just sort of puts you in a much worse position where you knew you were making money that was liquid. You really should have accounting for it, and the IRS is going to come down a lot harder on that kind of stuff. So it's something to think about from like a high level strategy. There are people get paid lots and lots of money at like law firms to basically analyze these risks, understand it, write a memo the company keep on their file. That then, if the IRS does come knocking, they have something to produce that says, "Hey, we made a best effort attempt at doing this correctly by our understanding of the law. Here's a letter that we wrote." So, anyways, it's just, but that's a rich person game. You know what I mean? Like that's a big company game. That's not I'm doing a little bit of stuff on my own. That I just want to I just want to deal with correctly.
Gotcha. Hey, and we have a couple of specific questions out of the Lido community.
Nice.
Yeah. So one of the questions is, are there ways to minimize tax implications by not taking direct control of the assets, i.e. Not having authority to buy, hold, or sell at the time and then receiving the ETH again?
Interesting question. You probably want to talk to a professional about it. At the end of the day, the direct authority from a legal perspective is different than a crypto perspective. So always keep in mind, like there is a delta between direct authority as we tend to think about it, which is like, do I own the private keys that do this versus, in a traditional world, I don't like, if let's say you're trading on TD Ameritrade and you have stock in TD Ameritrade, like I don't own that stock. I don't have the private keys for that stock. In fact, even TD Ameritrade doesn't. It sits in an account in DTCC, which is a central clearinghouse. But I have the right to call TD Ameritrade and tell them what exactly to do with that stock. And so that falls under my dominion of control. That is considered mine. Like TD Ameritrade can't really just arbitrarily sell it unless I enter into a contract with them for margin or whatever. I have full control over it, or my estate does if I were to get hit by a bus. So like that is my asset. So there's, again, you get into this place of like, you want to play too many games here, because even if you have any mechanism to control the asset, it is probably under your dominion control. And even if you are kind of segregating ETH out of that, but you have some sort of holding token, the Lido holding token itself is a token that needs to be fair valued. So it's one of those things like, there's like, you see TikToks and things like this when people talk about this stuff and, figured out the most clever like loophole ever. Like it's one of, just keep in mind, like the government has a lot of leeway to ignore the cleverness of your loophole, and the government has a lot more money to fight the legal battle than you do, and so tend to take a more government friendly approach. Um, like tend to assume that the government that like the more aggressive governmental stance, or like the more conservative stance from your perspective is probably the right one. It's hard to find a lot of wiggle room in with these kinds of like machinations.
In a somewhat similar vein, is depositing ETH into a liquid staking considered a sale or simply a receipt of claim?
It really does. It depends on the protocol that you're using. But with something like Lido, where you do actually deposit it and you get a token back, that is so. This is a really hard question because this also impacts other things like going into a staking protocol like Compound. So when I go into Compound, did I just sell my ETH and buy the Compound ETH token, or did I maintain control of my ETH, but it's now in a different asset that's just wrapped up? Because in some ways, Lido is kind of a wrapped token, but in many, many, many other ways, it's not at all a wrapped token because at the end of the day, it has a lot of liquidity. You can sell it, you can buy it, all that sort of stuff. So it's one of those things I would assume you're going to make a choice kind of in the broadest sense generally about how you want to treat this kind of stuff because the choice you're making will tend to influence like whatever choice you make for Lido will tend to influence the choice you want to make for Compound. That all does impact your overall tax liability and stuff like that. Um, it is it's hard to answer in the abstract, but there's a good argument to be made that in that case that is a disposal and a reacquisitions. Like there's an argument to be made that it's not, but there's a good argument made that it is. But what ends up being really tricky about it is you have to be consistent in that. So once you kind of make a decision about how you're going to treat it, because there is a lot of ambiguity from a legal perspective here. So is this am I treating this as a wrapping action where I still own the ETH? I just kind of have a different instrument that gives me rights to withdraw, like almost like a promissory note. Or am I disposing of the ETH and acquiring the Lido? Whichever you decide there, A, you should have your tax person should have a reason for making that decision. And B, the reasoning they use to make that decision should then apply to other assets as well. So staking into DeFi protocols, staking other blockchains and things like that. So it's one of the things that like you can make decisions there that are advantageous one way or the other, but then you have to be consistent about those decisions. You can't just arbitrarily say, "Oh, I did it here, I did it here, I did it here." Like that gets you into trouble. If you're going to make a decision like, "Hey, go into Lido, I still own the ETH, and I'm just holding a promissory note," that means that other places that you're staking like that, you have to treat similarly, non-disposal, and then yeah, obviously, as soon as you do non-disposal, you're being aware of things like wash sales and all the other kind of stuff there. So, that's all I can really say. It's a hard question to answer, but it's one of those things like whatever you decide, there's different ways to do it, and then you just have to you make a decision, and you have to be consistent about that decision.
Cool. That makes a lot of sense. Now we're headed up towards the top of the hours, so I wanted to see if you had any parting advice for people to plan for next year, and also if there's anything that you would like to announce.
Oh, well, so a couple of things we'll mention on our side. First of all, if anyone's interested in anything that we've been talking about here today, and in particular on like the business side, we have a conference. The conference is called the Enterprise Digital Asset Summit. We do it as a piggyback conference with Consensus. So the day before Consensus, we have a conference in Austin. It's going to be really, really fun. And if you are generally interested in it, please feel free to come. The URL is edas.live. So this is the Enterprise Digital Asset Summit. We have amazing speakers from Figment and obviously Bitwave, and we'll have a pretty spectacular from the big four. We'll have a pretty spectacular group of folks speaking of this. Any sort of general interest that you have in this, please go edas.live, and we have a code Blocknative100 to get you $100 ticket. So that's really, really fun. That's going to be a blast. That's April 25th, I believe, the day before Consensus officially starts. So if you're already down in Austin for Consensus, swing by. It'll be a great time. So Blocknative100 is the coupon code. edas.live is the website. At that, we're going to be announcing a ton of really cool new stuff around everything we've been talking about here. So we have a really robust set of changes that we have coming out around staking and DeFi and all that kind of stuff. They'll be really, really cool. So it would be great to see your folks there. Also, lastly, I'm excited. Like honestly, I've been in crypto since about 2010. I like the bear markets. I like the winters. I don't know if it's like 100% of them, but like the winters are when you see really cool stuff. I mean, like the DeFi, the DeFi summer came around because of the winter that happened over the 2 years previous to it. So, it's one of those things like these are kind of trying times. We're asking hard questions. But this winter in particular has been so interesting because, we have with this bank run, this SVB, FRB, ally issue we've had. It's been really interesting that like a lot of us kind of remembered why we got into crypto. Like I joke about this. I hate banks. We use FRB. I like our FRB banker. They're amazing folks. But like back in the day, my last startup, we used Bank of America, and I can't articulate a person or like company that I despise more than them. Like it was just the most miserable experience dealing with them. And so like a lot of us all kind of remembered like, oh yeah, like I remember why I really got into Bitcoin because I hate the current financial system in America so much. And it's been kind of really interesting. So it was like I actually I was hunkering down for this to be the full 2023 to be this long drawn out winter. Um, and then lo and behold, like something reminded us all why we got into crypto, and suddenly we're kind of like starting to nudge ourselves slowly back towards a bull market here. So
A little refresher course on why Satoshi wrote
a
that
little
book.
refresher course. Like it's like I saw that and I'm like the first thing I thought of was, Chancellor on brink of second bank bailout. I'm like, oh yeah. And it was so like the SVB one was so interesting because it really was this like it really encapsulated why we all hate it, which was it was very arbitrary. Yellen comes out and says, absolutely no way are we bailing them out. And the next day bails them out. And like it's not that I want anyone to lose money. It's not that I wish ill on anybody. It's not that I want the US startups to fail. It's that like we all just want rules that apply to everybody. And so she comes out and says no bailout, and then bails them out. And you're like, well, wait a second. Like I thought you said no bailout. Why does this get a bailout? Because these are startups as opposed to just individual lenders and stuff. So it's just one of those things. Like I'm excited about crypto this year. We're seeing some really cool stuff happening around payments. I mean, that's what I'm most excited about this year. As everyone is cost cutting and figuring out ways to streamline their operations, we are seeing these movements towards really using crypto for payments. And when I say that, I mean like USDC, ETH, things like that, for real payment use cases that we'd all thought about. Like everyone who's in crypto at some time had thought about what it means to get paid in crypto or pay someone to buy a coffee. Like everyone loves talking about what it means to buy a coffee with Bitcoin, or like why you should never buy a coffee with Bitcoin, or why you should buy coffees. Like it's a great topic. Anyways, we're finally starting to see that come to fruition this year. It'll be businesses that do it first, followed by maybe individuals at some point. But we are genuinely excited about the payments use case. We got some really cool stuff coming out around that this year as well. So,
Likewise, we at Blocknative are super excited about building throughout this winter and the spring to come, and certainly appreciate you taking the time to share your knowledge and depth of experience in the crypto accounting and crypto tax space. I know I'm a lot smarter now. I suspect a lot of people on the call are
hopefully smarter, maybe more questions than answers, but hopefully some good answers too.
Great answers.
This was spectacular. Thank you so much for having me. Really appreciate it, brother.
Likewise. Take care. Ciao. Once again, not been financial or legal.
Yep.